Dear students, welcome again. We were discussing the part 11 of the course titled Principles of Management. In the course so far, we were discussing about the controlling techniques. And in this controlling technique, we have seen the two methods of the controlling technique. One is your traditional controlling technique and your modern controlling technique. In the traditional controlling technique, we have learned about the observation methods, ratios in your statistical analysis, budgets, okay. And in the modern technique, so far we have discussed about the balanced scorecard and integrated ratio analysis. Continuing the modern methods of the controlling techniques, we will be highlighting our session module 54 towards understanding two more modern techniques, that is your zero based budgeting and economic and financial measures. Okay. So, we have discussed about the budgeting thing, and budget is a financial statement or estimation of the total cost to be incurred in a project over a period of time. But zero based budgeting is something different. What we have seen in the budgeting, that we takes into the consideration of the earlier year data or earlier year pattern of the sales or whatever the expenditure that we are preparing the budget for. We take the historical data and we keep those data as a base for the preparing the budget. However, zero based budgeting is something different. So, let us discuss how it was introduced and who propounded this zero based budget concept. Peter Fire is credited with introducing the concept of zero based budget in the year 1970. Alright. He identified the limitation of traditional method of budgeting and emphasized incremental adjustment to the previous year's budgets. Any kind of theory, any kind of concept, like we have discussed the evolution of the management concept, and in that we have seen the classical approach, neoclassical approach, contingency approach, system approach, and each of the concept or each of the concept of the management has some kind of limitation. The scientific method was some kind of limitation. The human relation has some kind of limitation. Fayol principle has some kind of limitation. Your motivation theories have some kind of limitation, and because of which the new theories emerges. This is the way the new concept are developed. Okay. Like we were earlier using the 2G, 3G, currently we are using the 5G. In the future it may be that we are using some advanced networks. Okay. The same way the traditional method of the budgeting has some kind of limitation, that we were considering the the budget aspects or the base of the budget was totally dependent on the historical data. Like imagine the situation, the time when the pandemic happened, alright, that situation was totally different in today's situation. If we consider the sales data, the any kind of capital expenditure data, the labor data, and prepare the budget based on that, what will happen? The budget will be a complete failure, because the situational aspect was not taken into the consideration. And because of these limitations, Peter has developed a zero based budget. Now, what is zero? Zero means you are not taking into the consideration any earlier or the previous year data, and you are starting the budget or preparing the budget from the scratch, or we call it as a zero. That is why the zero base, zero means the scratch, you are not considering any kind of previous year data. Base means what is the like basis for the preparing of the budget. Although it is a little bit difficult to prepare the budget without having any kind of base. We will be discussing the advantages and the limitation part as well. Now, according to the Daniel Laja of IBM, okay, IBM is a company, the zero based budgeting process is a strategic budgeting approach that mandates a fresh evaluation of all expenses during the budgeting cycle. So, it is compulsory that whosoever or the department is preparing the budget, okay, be it the sales budget, cash budget, your fixed budget, capital expenditure budget, labor budget, master budget, different type of the budget. Each budget will be prepared based on the fresh evaluation of all the expenses during the budgeting cycle itself. If you are preparing the budget for 2024, then whatever the situation in 2024 is having, a fresh evaluation, you will not be taking the data for 2022 or 2023, it will not be taken into the consideration. Only 2024 will be like the fresh year will be considered. That is why this aspect, the zero base, is totally neglected. Alright. Now, FIRE introduced the idea of starting the budgeting process from zero base, meaning that every expense had to be adjusted from the scratch. Okay. This approach challenged the assumption that previous year's spending were automatically justified, requiring individual and department to provide a detailed rationale for each of the expenditure. Now, as I mentioned, like zero based budgeting is little bit critical, because you have to provide very strong justification or rationale for any kind of allocation of the budget. Alright. Suppose the marketing department calls for the fresh budget of like 20 lakhs. Now, each amount of the 20 lakh need to be justified and provide a rationale that where these fund will be used. You cannot like take the previous year data that earlier we have used the 15 lakhs, so the market situation has changed. So, you like feel that based on your intuition, you believe that the 5 lakh more will be spent. These aspects are totally ignored. You have to provide the current year requirement for each of the budget that you will be preparing, and the management will be allocating the fund based on the justification or any kind of rationale for using those funds. This is zero based budgeting. So, in this particular slide, our understanding is with respect to the conceptual perspective of the zero based budgeting. We have discussed the thing about the budget. Now, zero based budgeting is the advanced or the modern concept of controlling. Okay. So, quickly we will be discussing about the advantages and the limitation part of your zero based budgeting. Very first one is cost saving. It means unnecessary allocation of the fund will be restricted. Those like decision or the budget which are prepared based on some kind of intuition, okay, not just some kind of scientific method like the current year requirement, you are like detailing all those facts, like the competitors product are getting momentum, so you need to have more on the promotional expenditure. Okay. So, it is something logical that you are speaking up, but merely comparing the earlier year budget and like calling for the higher amount of fund is not too much of scientific. It should be based on the current year situation, the contemporary factor which are dominating in the market, and based on that you are preparing the budget. Okay. So, ultimately what will happen? The cost will be reduced. Second is efficiency. If your cost is reduced, ultimately the subordinates are working very hard to make sure that the budgets are prepared like very comprehensively. It means all the factors are included as a justification to get the fund. So, ultimately the efficiency of the organization and the subordinates will be increased. Third one is the accountability. Accountability is with respect to the preparation of the budget. Like the traditional budget, also there was a accountability with respect to the departmental heads. We have seen like the departmental heads are given the responsibility to prepare the budget. The budget committee members or the budget officer will be compiling the different data together, that will be the master budget. Okay. So, accountability was also there in the budgeting part, but in the modern budgeting aspect or the zero based budgeting, you are more accountable for the fund that you are calling for. Suppose the marketing department calls for 20 lakh for the advertisement itself. So, you need to like justify, at the same time you are liable or accountable to use that particular fund, and make sure that the advertising effectiveness will be also seen. Merely using the fund is not the rationale or the objective. What is the impact of that particular fund in terms of sales or the profit or overall efficiency of the organization? These factors are also very much important. Flexibility and adaptability. The zero based budget is very much flexible, because you are giving the autonomy to the subordinate to make sure that you are preparing the budget based on the contemporary situation. So, flexibility will be given, the authority will be given to make sure the budget are very comprehensive. Okay. Next one is the cost conscious culture. The zero based budgeting, the overall perspective is towards reducing the cost. That is why it is a modern concept. If you are not able to increase the sales, ultimately what you do, try to lower the cost, so that you can bargain on the profit. That is the motto. Okay. So, cost is like reducing the cost is one of the factor under the zero based budgeting, and decision making is also improved. Okay. Because you are very much objective towards what you are doing. You are not doing the things in the vacuum. Okay. You are very much specific on what are the things that you will be spending up, that will improve your decision making. Other factor could be the limitation factor, the limiting factor of the zero based budgeting. Very first one is the time and effort. It will take too much of time of the subordinate to prepare and exhaustively review all the factors that will impact your budgeting aspects. Okay. So, time factor as well as the effort factor, it will be ultimately increasing the cost of the overall operation as well. Change management, it means like earlier, suppose the company was using the traditional methods, suddenly the zero based budgeting is like included or implemented. What will happen? It will like create a totally changed environment in the company. Okay. Like those subordinates will be taking too much of time to adapt towards the new environment or towards the new methods of the budgeting. So, ultimately the cost will increase, the time will increase. So, change management factor is also one of the limiting factor. Complexity, like it is not a cup of tea for all the subordinates to like prepare the budget. Okay. Even the budgeting, the normal budgeting is very difficult and it is very complex. You need to have good acumen and knowledge to prepare the budget. But the modern budget or the zero based budget is an advanced version of your budgeting that require like higher intellectual power. Alright. So, it is somehow very complex method. Resource allocation challenges. Resource allocation, it means like the fund allocation. If the management is very much not very much convinced on the way you have prepared the budget, like the production department prepared the budget and they called for the new equipments which will be required for the production processes. Okay. Now, it may be that you are not able to convince the top manager, these are very much important equipment for the production processes. So, ultimately what will happen? They will be not allocating the fund. Alright. So, this is also one of the limitation of your zero based budgeting. And initial disruption. Initial disruption means there will be a totally change in the way the employees or the employees will be in too much of pressure for the preparation of the budget. Okay. They are not using any earlier base year data for the budget preparation and they have to exhaustively explore all the factors. Okay. So, initial disruption will be there and over a period of time it will become a process part in the management, but at the initial stage it will create a havoc within the employees to prepare the zero based budgeting. Still, zero based budgeting is more comprehensive and it is more applicable for the different managers and it will enhance the efficiency of all the managers as well as the performance of the organization. So, this was all about the zero based budgeting, and moving beyond we will be discussing about the economic value added. The second modern techniques in this particular module is the EVA. We generally call it as a EVA. You guys must have studied or got the knowledge about the EVA, economic value added. Now, what is this thing? Economic value added was coined by Joel Stern, okay, and it is a registered trademark of a consulting company, Stern Stewart and Company, which is based in USA. All right. Economic value added means any surplus generated from the operating activities over the cost of the capital. Now, try to catch the keywords and try to understand the concept. EVA means the surplus generated from the operating activities over the cost of capital. Okay. So, it is the added value or the extra that you are generating from the operating activities over the cost of capital. Now, what is cost of capital? You need to understand what is cost of capital, then you will be able to know what is EVA. Now, the cost of capital is the expected rate of return by the investors who have invested in your company. Okay. Like suppose you are a company A, okay. You need some kind of fund or you need capital. Where you will be going? You will be going towards the different financial institutions. It may be your banks, public, okay, or any other sources. They will be granting you the fund. Suppose the fund is rupees 50 crores. All right. Now, all the financial institutions or different stakeholders, okay, these are considered as the stakeholders. Those stakeholders will be giving you the money, but at the same time they will be charging you some interest rate. Okay. So, the cost of capital is the uh, overall expenses for generating the capital. The capital that you have generated is 50 crores and you have taken the fund from the different sources, all these sources, alright. You have to pay it back certain amount of money as well. Why everyone will be giving you the money? It is not a free thing. Bank will be charging you certain interest rate. Okay. If you are taking the money from the public through IPO, initial public offering, or through issue of shares, okay, they have to be paid some kind of dividend. Okay. Other could be your the financial institution, like the big financial institution, like some other companies are giving you the money and all. So, the point is you have to pay it back in terms of the interest for getting the capital of 50 crores. So, those interest is overall the cost of capital. How much cost you have paid to get the 50 crore as a fund is your cost of capital. Now, try to understand the EVA. Surplus generated from the operating over the cost of capital. It is measure of the financial performance of a firm and see whether the company is creating wealth for the shareholders or not. Who are the main investors of the company? It is the shareholders, okay, the retail, or it could be QIBs, or it could be your some other companies. Okay. So, they have the direct stake in your company, they are the equity owners. So, whatever the activities that you are doing, any kind of strategic or the operation activity that we have discussed in the balance scorecard as well, ultimately their returns will be under the stake. That is why they are called as the stakeholders. Okay. And talking about the shareholders, shareholders are the investors, alright. Investor could be like your debenture holders, your preference shareholders, equity shareholders, they are the shareholders. Not going to discuss the different characteristics of each of the shareholders, alright. So, the point is EVA is a concept where your overall operating activity will be deciding whether you are getting the surplus amount of money as compared to the cost of capital. Okay. Try to understand with the steps which are involved in the EVA. Very first one is the measure of cost of capital. Suppose you are taking the 2 crores of IPO you are issuing. Okay. Now, the issue of IPO is going to the public, alright. You got the 2 crore of the total fund. Now, what the public will be getting from you? They will be getting some kind of dividend. Dividend that you are paying is, suppose the share price is rupees 10, alright, and dividend that you are paying is rupees 2. So, 2 rupees per share is your cost of capital, alright. So, cost of capital is the total cost that you are paying for getting the fund for or getting the capital from the different sources, alright. Determining the operating profit. The profit is like before any kind of taxes, okay. So, operating profit is like through any kind of operation, like you are selling, manufacturing the product, you are selling to the customers, alright. You are deducting all the costs that you have incurred. It could be your administrative costs, selling and distribution overheads, your factory overheads, your prime cost, direct cost, indirect cost. There are different classification of the cost. You will be deducting it from the total sales that you are generating. You will be having the operating profit, alright, the gross profit. Now, the gross profit is the second stage in the under the EVA. Third stage, first one, second one, third one is determining the net profit after tax. you will be charged with certain tax, corporate tax, and after deducting it you will be getting the NOPAT, okay, net operating profit after tax. So this is your net profit. Okay, what is EVA? EVA is your NOPAT minus cost of capital, net profit minus cost of capital. Suppose your net profit is, you are arriving is 20 lakhs, and the cost you have paid to generate 2 crores of the money is suppose 15 lakh. So deduct it from the 20 lakh, EVA is your 5 lakh. So you got the understanding, profit is something else and your EVA is a totally different concept. Now EVA will guide you on whatever the operation that you are making, and as compared to the, or after deducting the cost of the capital, how much money that you are paying for the project or for the capital for the project. Alright. Now again, application of the EVA is the business planning, good for the investors, valuation and employee compensation. Okay. Like if you are having a good EVA, positive EVA is a good thing for the company. If the cost of capital is higher than the net profit, ultimately your EVA will be negative. So business planning will be done, and all the like planning, staffing, directing, every function of the management will be based on your EVA thing. How the cost of capital can be generated, how the, not generated, how the cost of capital will be determined. If suppose you are having, you need 5 crores of the total fund, there are the different sources. Okay, it could be you are doing it through the IPO, it could be through the banks, alright, from the financial institution, and each of the sources of the fund is having the different cost of the capital. Suppose it has 7%, it has 9%, it has like 8%. So you have the option, take the decision that generating the cost or generating the capital through IPO will be having the lowest cost of the capital. So this is the part of your business planning. Second is, it is good for the investors. Like we can search the percentage of the EVA of every company. We like through the balance sheet, we know what is the net profit. Through the balance sheet, we can know what is the cost of the capital. So you can calculate the EVA. The company whose EVA is higher, we can invest our saved money in that particular company. So it is good for the investor to compare the different companies based on that EVA's parameters. Third one is valuation of goodwill and as well as the shares. Okay, suppose the company is trying to amalgamate or making a joint venture or merger and acquisition. They are making some kind of strategic alliances. Together we call it as a strategic alliances. So EVA or MBA, in the next topic we will be discussing about the MBA. These two factors are like deciding the overall valuation of the company. Okay. If the EVA is higher, then the valuation of the company will be higher. Other factors are also there for the valuation, but EVA is also one of the important factors. Employee compensation, like why we are studying this controlling as a controlling technique. The employee will be judged over the EVA. Suppose over the past 5 years, your EVA was increasing. Suddenly in the 6th year, the EVA was sharply, it was down. It need to be like controlled, that what are those factors because of which the EVA as a like parameter we are like losing it. So compensation of those factors, or like the employees are doing well, the employees will be compensated through the bonus or the rewards, and if it is not, the employee will be like need to be looked into the situation that where we have failed. So, with this we have discussed about the EVA, and lastly we will be discussing about the MVA, and before that, like advantages of the EVA: capital efficiency, it will increase the capital efficiency, more focus on the capital structure, like through equity shares, through debenture, what could be the sources of the fund, alright. Strategic scenario or the planning will be enhanced, acquisition analysis tools, like based on some EVA factor you can acquire some small company or you will be merged with some other company, and it has long term perspective. MVA is a similar concept, but it does not measure the financial performances. It is simply the difference between the current market value of the shares and the initial contribution by the investors. Suppose you have invested 10 lakhs like 10 years before in a company. Now the company has like grown and ultimately the value of the company is now like 1 crore rupees. So MVA is market value added, is how much value is added towards the shareholders fund based on the current market value. Okay. So that is why we call it as, or we have a formula, MVA as a current market value of the shares minus book value of the shares. When the shares was listed in the any stock exchanges, okay, and what is the current market value of those shares. Okay, like it may be like you can take the example of the SBI as a share. When it listed, it was like 20 rupees or 30 rupees. Now the value of the share is more than 600 to 650. So the current market value of the share is higher and the book value will be always lower. So market value added is a similar type of concept, but it does not measure the financial performances. So with this we have discussed two more methods of the controlling technique, and in the next module we will be completing the part 11 with another methods, that is the total shareholders returns and your network analysis and the MIS. That is all for the session, and before that I am leaving you with some suggested books, you can go through it. That is all. Thank you so much.